Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There's been plenty of volatility in equity markets so far this year, which has probably made for a lot of nervous investors. But how do you invest if you're looking for long-term, more consistent returns? Does all this short-term volatility matter? Hugh Dive is the founder and chief investment officer of Atlas Funds Management. Hugh, welcome to Fear and Greed.
Yeah, good morning, Sean.
Firstly, let's start with your philosophy because I want to talk about it. Atlas Funds Management's philosophy is smaller certain returns today are worth more than larger uncertain future returns. Are you talking dividends? Is that what that means?
Yeah, for a bit of dividends. So when we look at that, investors sort of systematically overpay for blue sky and sort of the future earnings are very, very distant in the future. And they undervalue those certain returns today. So I know sort of in terms of my background, I started off as a young analyst in Canada, working for a big fund manager over there, and saw the Canadian sort of tech wreck first up, where sort of some very, very large tech companies which had earnings a long way in the future, such as sort of Nortel, Research in Motion, the makers of Blackberries, which we all used to love, were huge companies. That was Nortel was 30% of the index, Research in Motion was fourth of the largest stock in the index, and these all had sort of returns far out in the future and very little earnings today. When the tech wreck came and these companies sort of fell to bits, there was not the dividends to cushion their falls. So, and we saw this a bit like in January, where we saw the markets falling sort of quite heavily. Markets, I think, Australia, the ASX was off about 6.5%. And the companies that were hit the hardest were those without dividends, because the dividends provide a bit of an airbag. So in terms of our underlying philosophy, we quite like dividends and prefer that certainty of money hitting our sort of cash accounts and hitting the client's accounts today rather than sort of future returns in the future, because often companies promise sort of large returns in the future that don't get delivered. Also, sort of with dividends, we see sort of time and time again that management teams can restate earnings and restate EPS due to sort of aggressive accounting treatment, but they can't restate a dividend that's already hit your bank account. But we like that certainty.
So, I mean, I'm sure many of our listeners, particularly who aren't institutional investors but are more retail investors and retirees, that dividend certainty undoubtedly is extremely attractive. The downside, though, does it mean that you can miss out on some big capital gains in tech stocks, for example? You gave a couple there who didn't do so well, but certainly some of the, the Facebooks of the world, notwithstanding recent activity, they kind of rose really hard even when they weren't making money.
I think sort of I'm an Australian investor, so I can't invest in sort of Facebook in the portfolio. So what I'm trying to do is we're trying to focus on sort of providing sort of systematic income.
Yep.
And a lot of these sort of tech companies have done very well in a period of very low interest rates. And where that sort of matters, which may be a bit difficult for sort of some of the listeners to understand, is that when someone's valuing a company with large amount of earnings 20 or 30, 20 years in the future, when you discount those earnings at sort of 1%, they look very large. When interest rates go up and you have to discount those earnings 4%, the future value of those earnings come down, but also the future value of the earnings getting paid today by boring companies like sort of Amcor and the banks, that increases. So that's something to think about there.
So Commonwealth Bank last week announced a higher dividend. In fact, I think it was probably higher than most people expected. Yeah. That's kind of an example of what you're talking about.
Yeah, so that was a very pleasant surprise for investors. So Commonwealth Bank, they increased their interim dividend from $1.50 to $1.75, so almost getting back to the $2 we paid pre sort of COVID, and also came in with a surprise $2 billion buyback. So that's very good news for investors, and that's sort of an example of sort of future income today. But for me, as a sort of an institutional investor, one of the things I like about sort of dividends, in particular part of that franking, is not so much the advantage it gives to our investors, but it actually sort of proves up earnings. So one of the things about dividends, I mean, a company board is not going to declare a dividend unless they're very certain about the outlook of the earnings.
Yeah.
And second, with franking credits, a company's CFO, they're not going to overpay taxes. So in order to pay franking, you have to pay tax to the ATO.
Yep.
And they're not going to overstate that. So they're not going to pay more tax than they have to. And we saw that sort of during the GFC. Companies like Babcock and Brown and Allco, they were able to declare very good dividends, but they didn't pay very much franking because the profits were sort of largely illusory from shuffling money around, and no money was actually being paid to the ATO. So franking, what I like, is it sort of gives a bit of an earnings quality measure. It shows that these earnings are real, because no CFO is going to pay more tax than they have to.
Yeah.
Secondly, on the franking there, is it's a bit of an undervalued area for Australian investors, in that tax laws prevent foreigners from using franking credits. And that results in their sort of systematic undervaluation, because around about 50% of the ASX is owned by foreign investors. And we see that in some of these buybacks that we've seen over the last couple of years, where foreign investors have sat off these off-market buybacks. So we saw Ampol do one, CBA did one last year. And they were very good for domestic investors in that you've got lots of franking credits and you got much more than your fair share of allocation because the foreign investors just step back because they can't use them. So that's sort of one of the reasons why we like franking credits.
Stay with me, Hugh. We'll be back in a minute. My guest this morning is Hugh Dive, Chief Investment Officer of Atlas Funds Management. Okay, so franked dividends, which companies do you like at the moment with that in mind? Which local companies?
Oh, so there's a lot of good-looking ones on the market. Looking through there, the banks all look sort of pretty good. They're sort of what we've seen in the most recent reporting season, coming back very strongly, very strong sort of returns. Looking through elsewhere through the market, I think something we quite like is Deterra Royalty Trust. That's the Royalty Trust spun out of Iluka. It's a royalty trust, so you're not exposed to mining costs, just pure iron ore, but totally franked. Looking elsewhere through there, Sonic Healthcare, very highly sort of franked. A lot of companies have done well out of COVID-19, but no one's done as well as Sonic Healthcare. Their result, wouldn't be surprised if they're trying to minimise how much money they're really making. Looking elsewhere, similar in that mining vein, Woodside Petroleum, obviously doing very well out of rising oil price, but paying very high sort of franked dividends. Similarly, sort of Wesfarmers, everyone's been buying a lot of Bunnings products, even though there has been a bit of disruption. So still sort of very hot, strong sort of franked dividends. So there's a lot of franked dividends out there.
Okay. And you do, I want to talk about property in a moment, ex-property, ex-REITs. You're kind of agnostic in terms of sectors. It's much more about what the company's doing, whether they're real earnings, whether they're paying dividends and whether they're franked.
And whether those dividends are growing. Because do you know what to own a dividend that's not growing? We've got inflation running at sort of 3%. The company's got to be better to generate a higher dividend within several years to make up for inflation. You've got to protect your earnings against inflation.
Okay, so let's talk about REITs.
Yep.
It just seems that the property market, given what has happened in the last couple of years with COVID-19...
So it's been 2020 was a bit of a rough year for anyone that had anything to do with sort of real assets, and that no one was ever going to use a toll road again. No one was ever going to go to office, or shopping centres were going to be deserted.
Yeah. The thing that has surprised me, though, is that construction seems to continue running pretty well, notwithstanding how much they were sold off in 2020. I mean, they've come back a bit, but how does that all work?
Oh, you mean as in looking around the city CBD, some construction?
Oh, yeah, but even Mirvac last week came out and said, we didn't have a great time with our retail centres, but wow, people are building homes and building offices.
Yeah, I think with a lot of the offices, they're very hard to stop.
Yeah.
So I'm looking out in Martin Place right now. There's a range of cranes everywhere. These are things that were put in place well before COVID-19, and there's such a long lead period. But ultimately, what we're also seeing is a lot of foreign money coming into Australia, pension money from Southeast Asia, from Europe, looking to buy Australian assets. So whereas Australians are sort of shying away from assets on it with a yield of 3 or 4%, that looks pretty attractive to a German pension fund when they're facing bunds at like zero. Yep. So we're still seeing money flowing in. They're still seeing transactions. So that's sort of why we're seeing the stuff still being built.
Okay, so do you like the real estate investment trust sector in Australia at the moment?
It's a tough question to answer because it's not a very homogenous asset.
Yeah, yep.
So a broad sort of I like it is not so great. So in terms of where we're positioned in the portfolio, we have some industrial properties. We have very little discretionary retail, so that's sort of the glitzy malls like sort of Westfield, Sydney. I think that there will be sort of a hard road out there. We have a big overweight to staples retailing. So that's sort of companies like SCP and Charter Hall Retail, which is a Woolworths in the suburbs with Dan Murphy's next to it. Yep. During lockdown, those things did very well. People were buying food, and certainly I know I was buying a lot of Shiraz on those dark days when the markets were down 10%.
We all were, Hugh. We all were.
And that didn't move. Indeed, like we saw SCP came out this week. They have seen no drop-off and everything's going better than it was before COVID for those boring regional malls. Don't have much office. I think office, there's still a bit of to play out in that the big companies are still sort of coming back. I think we'll see vacancy increase in the office market. Where we also like is that medical educational sector and then also the infrastructure sector. Residential is not a big part of the LPT index. I know the casual sort of viewers would think that sort of residential property is a big part of the LPTs. It's not. It's about 5% overall. That's because institutions are at a massive disadvantage compared to individuals investing in residential property, in that there's no negative gearing and there's no sort of capital gains free tax. So consequently, the residential exposure is the likes of sort of Mirvac and Stockland, where they develop something and get it off their books as fast as possible. They don't actually own or they don't want to actually own any residential property. The only time they own residential property is when something's gone wrong.
Yeah, okay. Hugh, thank you. You've given us a great lesson in why franked dividends are things to keep an eye out when you're investing.
Yeah, it means those earnings are real.
Yeah, absolutely. Thank you for talking to Fear and Greed.
Thanks very much, guys.
That was Hugh Dive, founder and chief investment officer of Atlas Funds Management. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.